Imagine a world just a couple years from now where the opening bell on Wall Street is, well, it's basically just a historical artifact. Picture this. You're trying to get some sleep. It's 2 a.m. in New York, and suddenly a huge earnings report drops out of Asia. And you can trade U.S. stocks right then and there. No more waiting. Or let's flip that. You have maybe $50 to invest, but the one stock you want is $2,000 a share. Can you still get a piece of the action? These are the kinds of shifts that are, completely redefining what it means to be an investor. And it's all happening so fast that by 2026, the markets will look almost unrecognizable. If you want to get up to speed on all this, you've come to the right place.
The speed of this change is just...
Yeah.
It's incredible. It's not an evolution. It's more like a total redesign of how markets work, driven by tech and, globalization.
Right.
Every single one of those scenarios you just laid out, they're not just theories. They're either happening right now or actively being planned.
Okay, let's unpack this. Our mission for this deep dive is to look at 3 pillars that are going to define trading in 2026. First, the big push for 245 markets. Then we'll examine fractional shares. Are they really democratizing finance? And finally, we have to talk about the rise of AI and algorithmic trading.
And the big question through it all is, when the market never sleeps and machines are in charge, who actually wins?
Exactly.
It's a real tension. The promise is amazing access and convenience, but the reality is it's a lot more complex and there's some serious risk involved. Let's start with what happens when the market decides to work around the clock.
For generations, the U.S. market has run on a very human schedule. 6.5 hours, it controlled everything. But that model is, it's pretty much dead. So what are the actual plans we need to watch?
Well, it started pretty quietly. Back in 2024, the NYSE started to lengthen its trading day to 22 hours. But that was really just, dipping a toe in the water.
Okay, the warm-up act.
Exactly. The real goal, the one NASDAQ is pushing for, is a full 24/5 schedule. 24 hours a day, 5 days a week. And they're targeting the second half of 2026 for that.
So NASDAQ wants to turn the U.S. market into this perpetual global utility. And the sales pitch is all about convenience, right?
Absolutely.
Yeah.
The main argument is global responsiveness. Think about an investor in, say, Sydney. They don't have to wait for the U.S. to wake up to react to some major news anymore.
They can just trade.
Instantly. It allows for continuous price discovery, and in theory, it makes global capital flow more efficiently.
That seems like a clear win for international investors. But when you look at how it'll actually work, especially in those, the dead of night hours, I start to get a little worried. What are the risks the sources are pointing to?
It really comes down to 2 things: fractured geography and thin liquidity. At 3 a.m. Eastern Time, sure, traders in Asia might be fully active, but London is asleep, and most of the U.S. retail base is too.
So you have a lopsided market.
Precisely. And that creates these big liquidity gaps. When fewer people are trading, even a small order can move the price a lot.
And that leads to wider spreads.
Wider spreads, which means it costs you more to trade, and much, much higher volatility. You could see a flash crash in a single stock that would normally get absorbed during the day, but at 3 a.m., it could trigger a real panic.
That sounds like a recipe for what the source material calls emotional overtrading. People just glued to their screens, making bad trades in their pajamas.
And the costs for the exchanges themselves are huge. They need compliance, security, tech support, all staffed 24/7. Regulators are still trying to figure out how to even police a market like that.
Which brings up a core question for you, the listener. When 245 is a reality, will those late night hours really help the average person? Or will they just become the playground for huge global institutions and the high-frequency algorithms we'll get to in a bit?
That gap between perceived access and who actually dominates is the perfect bridge to our next topic. Because it's the same tension we see with the one tool that truly has opened the market up for millions: fractional shares.
Fractional shares, the idea that you don't have to buy a whole share, this has been a massive deal for accessibility, hasn't it?
Oh, it completely solved the sticker shock problem. Before, if a stock like Amazon was thousands of dollars, it was just out of reach for someone starting out. Now you can invest with just a few bucks.
And it's also a huge win for just smart portfolio management.
100%. It unlocks real diversification for small accounts. Instead of putting all your money in one stock, you can buy tiny slices of 20.
Right.
And you can put every single leftover dollar to work.
Yeah.
No more cash just sitting there.
It sounds like pure democratization. If the goal is to open the market to everyone, this is it. But the devil's always in the details. If you own a fraction of a company, do you really own it? What are the limitations?
And this is where we have to read the fine print. You get the economic upside, the gains, the dividends, but you often lose corporate control. In most cases, you do not have voting rights.
Wow. So you're basically just along for the ride.
You're an economic passenger, not a corporate owner. That's a huge distinction.
What about moving your shares? Can I take say, my little piece of Tesla and move it to a new brokerage?
Almost always, no. That's a major point of friction. Fractional shares usually cannot be transferred. You have to sell your position, which can trigger taxes, and then repurchase it at the new place.
Which is inefficient. And what about the actual price you get, since the orders are all bundled together?
Exactly. Because they're aggregated, the price you get might be slightly different from what was quoted on the screen the second you hit buy. It's just an operational reality of the system.
Okay, but here's the really interesting contradiction. We're hurtling towards a 245 market by 2026, yet our sources are crystal clear on this. Fractional shares are almost always restricted to regular trading hours. They are explicitly excluded from extended sessions.
That exclusion is a massive problem for the whole democratization story. If the most important news-driven trading is happening overnight, the small investor using fractional shares is just locked out.
It creates a two-tiered system.
It does. A system where only investors who can afford whole shares get to play in the full 24-hour market. Small investors get a slice of the pie, but they don't get a seat at the table when the biggest moves are happening.
Let's move on to the last pillar, the one that controls the speed of this new market: AI. It feels like every conversation about finance comes back to AI now. Just how big is this getting?
The growth is.
Yeah.
It's staggering. The algorithmic trading market was valued at around $3.28 billion in 2025.
So just last year.
Right. And forecasts show it nearly doubling to about $6.05 billion by 2032. That's a compound annual growth rate of roughly 9%. This isn't just adoption, it's a deep exponential reliance.
So why the frenzy? What does machine learning actually give a big institution that a human trader can't provide?
It's about seeing patterns that are just invisible to the human brain and executing on them with a speed and precision measured in microseconds. High-frequency trading already dominates so much of the market volume.
So human reaction time is basically obsolete?
In many ways, yes.
Yeah.
AI just supercharges that speed and adds a layer of, really sophisticated prediction.
It sounds like the competitive gap is just getting wider by the second, but you have to look past the speed and at the risks, right? What happens when the machines are in charge?
There are two big concerns. The first is that competitive imbalance we've been talking about. The retail investor is like competing on a bicycle against a rocket ship. It just feels less fair.
And if that rocket ship misfires?
The failure is instantaneous and potentially catastrophic. If an AI misreads a data feed or gets hacked, the shock to the market isn't human-paced, it's immediate. And it could cascade across markets before a person even sees an alert.
So the regulators must be worried.
Very. The sources point out that cybersecurity and regulatory compliance are the two biggest things slowing down an even faster adoption rate right now.
So what does this all mean for the everyday investor? Will AI eventually level the playing field by giving better tools to everyone, or will it just widen the gap forever?
That is the defining question for 2026. The technology is powerful, but using it effectively requires massive resources, which concentrates power at the top.
This has been a really compelling and honestly a slightly unsettling look at the near future. Let's try to pull these three big shifts together.
The core theme across all of them, 245 trading, fractional shares, and AI, is that the market is chasing maximum access and speed.
Right.
But the trade-off is that we're sacrificing things like stability, simplicity, and equal participation rights.
Extended hours give us convenience, but they risk volatility. Fractional shares give us access, but they limit real ownership rights.
And AI offers incredible efficiency, but brings this huge dual threat of competitive imbalance and, frankly, systemic risk.
The common thread, really, that we found in all our sources is that this technology is empowering, but only for investors who understand the new rules and the new risks. Showing up unprepared in this new market is just our recipe to be taken advantage of.
Adaptation is everything, especially when you see how these trends sometimes directly contradict each other.
Which brings us to our final provocative thought for you to chew on. Given that 245 trading is coming, it's pretty much a done deal for 2026. But the great tool for democratization, fractional shares, is currently locked out of those extended hours. How do we fix that? How will regulators and exchanges reconcile these two futures? What has to change to make sure that the door to accessibility doesn't just slam shut at 4 p.m. every day? Because that harmonization, or the failure to achieve it, is going to be the next big fight shaping the market you invest in.